Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm going solo to talk about where you can hide out, if anywhere, during these turbulent times while the tariffs are going on and the stock market is gyrating, selling off, rallying, whatever it is doing. I know a lot of people are freaked out, and maybe you don't just want to buy a stock on sale because it might go even more on sale. So you don't find that to be a safe haven. But in times of volatility, a lot of times there is no safe haven. But I've brought you 3 stocks to maybe consider for your portfolio as we move ahead this year in 2025. There's a lot of different areas maybe to consider for safe haven type of stocks. But again, as I said, in a true market sell-off, as we've seen in recent days here in early April of 2025, pretty much the baby is thrown out with the bathwater. But some have taken it on the chin more than others. Obviously, any company that's going to be directly impacted by the tariffs, like a retailer who makes all of their goods in Vietnam and China, they are going to see a direct impact on those tariffs. So we're going to stay away from anything like that. But tariffs can kind of work their way in there more dubious than you might think. It is hard to actually avoid them altogether because even in some certain situations where you think, where you think that you might be able to get around them by buying, say, a purely domestic company or a company that seems way out of anything that would be tariffed, there is still some tariff impacts. So that being said, I have picked 3 stocks this week to talk about and take a look at that might offer some variety of protection, not 100%, nothing is, but some variety of protection. So let's dive right in. The first stock I want to talk about is Ventas, ticker V as in Victor, T as in Tom, R as in Robert. We're going for the REITs, but you can't just do any REIT. And remember, a REIT, R-E-I-T, is a real estate investment trust. They own real estate. They generate income. They pay it to you, hopefully in the form of some dividends, but you are a landlord if you own a REIT. And it's an easy way to become a landlord versus going out and buying the properties yourself and dealing with tenants and all of that yourself. So there's a lot of different REITs out there in a lot of different areas. Ones you would want to avoid here during the tariffs are anything in tourism, so hotels in particular. If we see less tourism in the United States due to what's going on with the tariffs and people making different decisions about where they might vacation, or even if they might vacation, then you probably don't want to own hotels here. Some other areas like shopping malls could also be indirectly impacted by tariffs because the U.S. consumer may say, I don't like where things are going. Prices are higher. I'm not going to go to the mall to buy those yoga pants. So we could see a little bit of outside impact on the shopping mall REITs based on what is going on with the tariffs and then how it trickles down into the U.S. economy. Even a possible recession, you don't want to own the malls. But one area you might want to own is healthcare, senior living. That is Ventas. So let's take a look at the Zacks.com quote page for Ventas, because some of you maybe never heard of this company. You can see that it's a number 3. It's got pretty bad style scores, D for value, D for growth, but it does have the A for momentum. And that's because the stock is holding up right now. It is being seen as a safe haven. Why would that be? So Ventas has 1,400 properties in the US, Canada, and the UK. They do senior housing, outpatient medical research, and triple net healthcare. They're the second largest owner of senior housing in North America with 800 plus communities. And for those of you, if you're listening from Chicago, you know one of the facilities they have, if you've been on Clark Street in Lincoln Park, kind of near Clark and Diversey there, the Sunrise of Lincoln Park building that's right on Clark there is an assisted living facility there that they own. So one of my concerns, though, with Ventas wasn't so much on the tariff side of things, but how much exposure they may or may not have to Medicaid. So what most people might not realize is that Medicaid, while it provides health insurance for poor Americans or people who just can't afford the regular and who have a limited income, it also provides 2/3 of the assisted living and nursing home care for the elderly. So I don't know. I kind of looked around on the website. I didn't see anything immediately that said if they have any Medicaid exposure at all, they may be completely private. And I'm only bringing up Medicaid because it appears that it may be one of the things that could be impacted by what is happening with the reconciliation bill on the Capitol Hill, but nothing has been decided yet. Nothing is set in stone. So we won't know if there's any impacts to Medicaid yet with that bill. But again, as I mentioned earlier, even with the tariffs or with other things that are going on in Washington, D.C., even the DOGE cuts to various programs can trickle down and impact these other businesses that might have business with the government, essentially. So that being said, the street still likes Ventas here because of its exposure to an area that isn't really going to be tariff impacted, even though it might be these other things. So just scrolling down, you can see the price consensus and surprise chart here now. And this is what we like. Very nice earnings growth up and to the right. We have a growing number of seniors now with the baby boomers all over the age of 60. That was always going to be the plan with the senior living communities. COVID kind of impacted the demand a bit for these communities, but that has seemingly rebounded here now. And you can see these nice broad bands up and to the right for 2025 and 2026. Of course, this is before any other things happen or any other impacts. This is what we know right now on April 8th. Dividend, it does pay $1.92, and that's yielding just about 3%. That's not too shabby here, given that that's why we're buying a REIT. Scrolling down, this is what really struck me when I was looking at this earlier before the podcast, the sales and EPS growth rates. Look at these nice green bars for 2025 and 2026. 2025, 7.8% earnings growth. 2026, 8.1% earnings growth. Very nice and very consistent. You're not getting the double digits. So that's where valuation has to come into play. I'm looking over here. Forward PE now is at 18.7 times. So it's not nosebleed expensive, but it's not dirt cheap either, given the higher single digit earnings growth, which is pretty solid. I would like to see this be a little bit cheaper here for me to want to get in. But if you're looking for somewhere to hide out, then this could be one of the places you might want to be. Now, what has it been doing over the last month? Because a lot of people have been turning to the REITs as a hideout place. As I said, most things are still being hit regardless. So I'm taking a look at the 1 month chart, and you can see all was pretty good until we had the big tariff sell-off after Liberation Day there. We have seen quite a nice little pullback. Let's compare it to the S&P here, and just to get a little bit better idea in a comparison. Okay, so S&P down 10.4% over the last month, almost 11, and Ventas down just 5%. But that's making it a little bit more attractive here to get in because you're not paying quite as much for these shares. So Ventas, this is where people are going. Should you go there too? Things are looking pretty good. It reports again on April 30th. So we're going to be tuning in then to see what's going on. One other area that could be hit by the tariffs are higher costs, possibly on food, other supplies, things that, they use in assisted living that go to the tenants, that kind of stuff, replacement carpeting, any kind of appliances, even paint, things like that could impact. But again, this is going to impact every business. We're looking for ones that are going to see the less amount of the impact. So Ventas, VTR is one of those. Okay, what else could there be? There's been one company I've been complaining about because it hasn't been pulling back during the post-Liberation Day sell-off, and that is Berkshire Hathaway, ticker brk.b. I'm pulling it up on the chart to get a look at how incredible it's been holding up. And you can see it was up and away until Friday after Liberation Day, actually. It did hold up pretty good the next day after. But then it finally got a pullback, about 6-7% pullback. And now we're taking a look at what's going on with Berkshire. Let's just do a year to date to kind of get a comparison. S&P 500 down 13.5%, but Berkshire up 10 here. Did have that mini pullback over the last 5 days, but here it is on the last 5 days. So down 6.5%, S&P down 9.3%. This is mostly after Liberation Day. So it has pulled back a little bit off, but still remaining pretty strong here. So why Berkshire Hathaway? Other than, it's huge. It's got Warren Buffett. People are trying to hide out in Buffett because he's been the place to hide out in the past during any kind of global market turbulence and even economic turbulence. I've scrolled down and you can see the price and consensus and surprise chart on Berkshire Hathaway. But look at these earnings. We only, I think, have 1 or 2 analysts on this company. So the earnings are a little bit rocky here, maybe as a result, but almost no earnings growth expected for this year. And 2026 looking better, but down off the highs earlier. So this isn't even all that great of a price to consensus chart compared to what we've seen and will see with other companies. So again, why hide out in Berkshire? Mainly, again, because of Buffett. A lot of his companies will likely see tariff impacts. So that's not the reason, but he's sitting on that huge cash hoard now. Over 300 billion. It's in the treasuries. It's generating a lot of income for him. And the cash is now seen as a safety play. Now, you could be asking yourself, why not just go buy, treasuries or get in a CD or money market that's paying 4 or 5% yourself with your own cash? You don't need to go buy Berkshire to get cash. You can do it yourself. That's a good question. But some people are still depending on his expertise and perhaps that he's going to use that cash hoard to get some good deals on companies that might find themselves into more trouble as these tariffs take hold, or, that's just what he's done in the past. Cash is king in the times of turbulence, and those who have it can get deals. So that might be why you might want to be buying Berkshire here, to hide out in that cash and Buffett's expertise. He has said just a couple days ago that he's not going to be talking about what's going on in the markets until the annual meeting in the first weekend of May. So we still have a couple of weeks before we hear from him about anything that's going on. So Berkshire holding up pretty well in the face of this. But another thing to keep in mind, and what I've been complaining about, is the price of Berkshire now. Forward PE is down a little bit on this recent pullback, down to 24.4 times. 24.4 times. That is a historic high. It was trading around 25 or 26 before it pulled back in the last couple of sessions. It's not really altogether cheap here. PEG ratio of 3.48. That's also still very pricey. People are willing to pay up for the safety play, if you're going to call it that. But at some point, even Buffett would tell you, if you're paying this much for the safety play, it's no longer safe. So keep that in mind, that you're paying a high price now to get Berkshire Hathaway and its cash and Warren Buffett here. But this is somewhere people are hiding out. So I would keep it on the short list. I've been watching it, as I've been saying, but just too pricey for me and a little bit riskier than what you might otherwise think. Looking up here, Zacks rank is a number 3 right now, a D for value. Go figure, right? Berkshire Hathaway is not a value here. F for growth, because there really isn't going to be any in earnings this year. And it's likely we could see a decline there depending on the impact of the tariffs. Remember, they own a couple dozen companies, and some of those are going to have tariff impacts because they're in many diverse industries. And then a C for momentum, even though the shares are trading near the all-time highs, for an F overall on the VGM. So not great on the style scores, but people still considering this a safety play. So that's Berkshire Hathaway, ticker B as in boy, R as in Robert, K.B on Zacks.com. Some other websites have a dash B there. But just put in BRK and it'll come up no matter where you are. So Berkshire Hathaway. Okay. And where else? Where else could you maybe try to avoid it? I tried to think of any possible, maybe some retailers that were only US domestic, but any of the products that they're going to be selling on those shelves, even if they didn't make them themselves, are going to be hit by tariffs, because these products are made all over the world, and you cannot escape any of the tariffs right now, as they're mostly 10% everywhere, and then additional reciprocal tariffs. So we can't go with someone who's just U.S. domestic. That eliminates a lot of the small cap companies as well. You would think, again, those would be mostly domestic, but we are all interconnected now, so that isn't it. Then I thought about, what about on the services side? There's got to be, software, cybersecurity, those kinds of areas, but it's unclear what kind of retaliation might happen against some companies, whether or not some countries might attempt retaliation on services companies because they can't really retaliate on manufacturing as easily with the trade imbalances. We don't know that yet. But one of the service side companies I thought we should take a look at is Netflix, formerly of Fangman, discarded from the Mag 7. Netflix, ticker N as in Nancy, F as in Frank, L as in Larry, X. I haven't looked at this one in a while. It's obviously making content. It's making films, television shows, streaming content, also buying it from various other content creators. It's global. It has streaming in many countries around the world. But you would think, because it's not actually manufacturing anything else, that this might not be hit by the tariffs. Now, one caveat would be if they decided, some of these countries, to go after the services side and maybe put a tax on, like, say, streaming services. We've seen that even in the United States, on entertainment. I want to say some cities and states are even trying to put taxes on streaming. I think they maybe decided not to. I'm not sure, but you could, see a 50-cent tax or something on a streamer to try to raise some local revenue, kind of like they put on our tickets when we go to a baseball game or football game, kind of thing. But globally, this isn't in manufacturing. So I'm hoping that Netflix might be able to escape a little more unscathed than some other companies. Now, one other thing that was similar that you're going to see across the board is impacts, again, on the U.S. consumer, saying, hey, prices are rising on all these things that I'm buying that are being imported in, and we've got to make some cuts in the budget somewhere. And so we're going to get rid of Netflix in our budget. But out of all the streaming services, I feel like Netflix is one of the ones that's kind of must-see TV still, and it might be the last one you're going to cut. Also, they recently launched a lower price advertising model, streamer that you could subscribe to if you didn't want to pay the higher prices where the monthly cost has gone up. Then you're willing to say, okay, we're going to keep this. We'll just have the commercials on. So there's options for these companies to try to mitigate any kind of economic slowdown. But let's look and see what is going on with Netflix. Is this a place to hang out and hide out here? So I'm scrolling down to the price consensus and surprise. And you can see earlier this year, it did touch new all-time highs. It has pulled back off, so maybe not quite the place to hide out in, or maybe it still is, because look at these earnings up and to the right with this nice earnings growth expected here. Let's scroll down and see forward PE now is at 35.3. I actually consider that to be kind of cheap, given where it used to be at 70, 80, 90 times a couple of years ago. So it has come back down. PEG ratio of just 1.8. That's not a value, but that's not stretched. Remember, Berkshire was at 3.5. So this is 1.8. So I'm liking what I'm seeing here. They are reporting earnings on April 17th. So we're going to find out those earnings very quickly here. And all these companies on every earnings report is going to get asked, how is the tariffs going to impact you? And so we're going to find out some answers here. They're not going to know how a possible recession or even consumer slowdown is going to impact them. But we do have some ideas based on what happened during the pandemic, and where some people might have been cutting certain items out of their budget, and even during the recent bout of inflation where people were trying to cut back as well. Over here, sales and EPS growth rates, you can see 2025 estimate up 23.9% on the earnings. For 2025, 2026, 20.7. So still with that great earnings growth, they did 64% last year. That is impressive on double-digit sales growth, 15.7% last year. Expected to be 14 this year, 11.5 for 2026. So it is helping to add those ads in there, but will the ad rates drop as well? That happens a lot of times in recessions. Advertising, first thing to be cut by companies when things get tight, and that will go towards Netflix and any other streamer like YouTube. Revenue will drop there as well, even if people subscribing don't really drop, the actual advertising will. So this is all looking pretty good, but as I said, the shares have pulled back. Here in early April, let's take a look at the 1 month here. I'm setting it up, and it was at those all-time highs. So not a surprise that some people were cashing in on this big event and just taking their gains and getting to the sidelines. But if you are interested in being a little bit more of a long-term investor here, maybe this is the time that you do want to kind of stay in it, or or get a new position. Okay, so the last month, S&P, let me re-click that because sometimes it kind of adjusts as you make changes to this chart on Zacks.com. So S&P 1 month now down 10.6%. Netflix is up 1.5 because it is seen as kind of a place to hide out. 5 days since Liberation Day, it is similar to Ventas and Berkshire. It's down. It just clicked over, down 5.2. S&P down 9.6 here over the last 5 days. So it's holding up better than the S&P 500. And that's what we're looking for stocks to hide out in. We're looking to do a little bit better than what the overall indexes are doing, and maybe even see some green like Berkshire Hathaway has been doing this year to date. Year to date on Netflix, it's basically break even. It's right there, hovering around break even year to date. Again, meanwhile, S&P 500 is down 13.7% year to date. So it has been a place to hide out. You will pay up for this, as we're seeing with Berkshire and with Netflix, a little bit less with Ventas because it's not as well known. Now, what about, I'm thinking off the top of my head, a couple of these other companies that were already kind of beat up going into all of this tariff scariness. And let's just add it to this chart. I want to talk about AMN Healthcare. That's A as in Adam, M as in Mary, N as in Nancy. That is actually the ticker as well, AMN Healthcare. It's a small cap company. Small caps have really taken it on the chin. You can see it on this chart way down here. This is year to date. It's down 20% year to date. It's not really getting any relief here at all. AMN Healthcare is a staffing company, US based and US staffing on healthcare. So this was a big winner during the pandemic when we needed all those nurses and doctors in various hospitals due to COVID. But that has slowed down. Wages have slowed down. Demand for the travel nurses has slowed, which has impacted the wages. So earnings have taken a decline on AMN, but this was already happening for the last couple of years. And now it's gotten worse. But staffing isn't going anywhere. And some stocks like this might be oversold. So let's just take a quick look. I'm throwing a 4 stock in there, calling an audible. It is a number 5, not surprising. Those estimates keep having to be cut because AMN keeps thinking, okay, this is the worst of it. We think we're going to see a bounce now. And then they still don't see a bounce in the demand for the nurses. And so those estimates keep getting cut, and we still keep getting the number 5 rank on this company, with the stock just falling. Now, scrolling down, you can see it's done the round trip. It is now lower than what it was when the pandemic hit. And that is a little more shocking to me because I have followed this company for many years. But look at the earnings, down and down. I owned this company in several times over the years, and we owned it during the pandemic. Then we got out as the estimates came down. We tried to get in again, thinking that the worst was over, and the company, 2023, we think it'll be better. 2024, we've hit the bottom. It's going to turn. 2025, same thing, but it's not happening. And so now the estimate's just down. The stock is being abandoned. This isn't a place necessarily to hide out, but it is a pure value play here as, fundamentals look pretty bad here. So you can see on the sales, EPS growth rates, 2023, 2024 were the quote unquote bad years, which we knew were going to happen. But because look at 2022 with that 48% earnings growth, that's when the pandemic was still in play, but just starting to wind down. This is the pandemic unwind, 23, 24. It was supposed to end here in 25, but look at this. I haven't looked at it in a while here. 71% decline, another 71% after 59% last year. And then finally, 2026, they think it's going to go up, but will it? Unclear. So these are the type of stocks where the Zacks rank is telling you don't hide out here, even though it's at 5-year lows because of the terrible outlook in the earnings. And even with this rebound here, let's take a look at the detailed estimates real quick. Even with that rebound, it's still not good. So look at 2025's earnings estimates here. A year ago in 2024, they made $3.31, 99 cents here this year. That's the 71% decline. Oh, this is showing 70. So that is off the cliff. And then next year, we are getting that nice rebound. This says 49% rebound up to $1.47. But that's still a struggle here. I feel like the PE and the fundamentals haven't really kept up. It's still trading around 20 times, even at these 5-year lows. So that tells me it might need to go a lot cheaper. I've bought this company at like 10 times in the past. So with this kind of earnings contraction, I'm not willing to pay 20 times for these earnings. So that's something you're also going to have to be watching if you're looking for a place to hide out. That's why I like the other 3 stocks that I did for this episode to show you where so far, as of April 8th, there is still earnings growth expected for 2025 and 2026, not 2025 with Berkshire, however. That could see a contraction, but 2026 expecting the nice rebound there. But the other 2, we're seeing for now this nice earnings growth, and that's what I want in a place to hide out. Not as much tariff impacts, maybe not as bad in a recession, but unclear because everything's impacted in a recession, and rising earnings estimates. So AMN would be just on my watch list as it's been for a long time, but I haven't looked at it recently because I knew things were still not good over there. So that is not probably a place to hide out, even though it has very little tariff exposure with staffing, nursing, and doctors in the United States. But other things in its business model are being challenged here. So let's recap those stock tickers again. We had Ventas at V as in Victor, T as in Tom, R as in Robert. We had Berkshire Hathaway, brk.b. We had Netflix, N as in Nancy, F as in Frank, L, X. And then AMN Healthcare, if you want to keep a watch list of some of these companies that are now at 5-year lows, below the pandemic lows. Ticker A as in Adam, M as in Mary, N as in Nancy is that one. And as always, every week as we go out throughout this earnings season, because that's starting this week, and as well as what's happening with the tariffs and everything else economic related, I'll be bringing you stocks, commentary, insights, all here at the Market Edge. And yes, I do want to have John Blank, our chief equity strategist, and he's an economist, on to talk about everything that's going on. But I'm waiting to see implementation of these tariffs and what goes on. We are in the middle of negotiations, apparently, with some countries on these tariffs. So it's a moving story. Even by the time you watch this, things will have changed again. But still tune in every week, trying to keep up. And you can get us on Apple. You can get us on Spotify. You can get us on video on YouTube at zacks.com/YouTube, or just put in Zacks Investment Research. Subscribe over there and you'll get all of our podcasts, our top stock picks of the week, and my earnings all-star videos, because those have started ramping up again. Lots of stocks and lots of information. So don't miss out. Get us somewhere. I'll see you again next week with some more stocks.